The Operator Log, Episode 4. How we think, why we don't build MVPs. Arco does not build on uncertainty, it engineers for certainty. 4 episodes in, we have covered what autonomous means, what agentic means, and why overhead is a consequence of architectural failure, not a cost of growth. Today, we close the loop on why all three of those claims depend on one prior decision, what you chose to build at the start. The minimum viable product is the unquestioned default of the startup world. Founders are told to build fast, ship incomplete software, and iterate based on market feedback. That advice has produced some of the most valuable companies in the world. It has also produced most of the structural overhead, coordination debt, and rebuild tax that those same companies spend their next decade trying to undo. Arco does not build MVPs, not because iteration is philosophically wrong, because our architecture does not permit half measures, and the reasons for that constraint are the subject of this episode. This is the operator log. The MVP model was built for a specific and legitimate problem. Founders who did not know whether a market existed. If you are building something nobody has asked for in a category that has no prior revenue history, with no data on whether anyone will pay for what you're building, shipping something small and iterating toward what customers actually want is irrational. The primary risk is market existence. For that risk, the MVP is a sound instrument. The mistake is treating a tool designed for one context as a universal default. The MVP was designed for uncertainty. Not all businesses begin in uncertainty. When investors and accelerators tell founders to build fast and iterate, they are giving advice calibrated for the worst-case scenario, the founder who has no market data, no existing demand, and no validated assumption to build from. That advice, applied without adjustment to a market with a decade of documented revenue, is the wrong instruction for the wrong problem. It imports the risk management framework of a speculative bet into a situation that is not speculative. It turns a known quantity into an unknown one, unnecessarily. Arco does not enter markets to discover whether demand exists. We enter markets where demand has existed for a decade or more, markets where the customer is already paying, currently being served by a slow, human-heavy incumbent, and structurally underserved by the delivery model they are locked into. The market risk has been neutralized before a single line of code is written. What remains is execution risk. And execution risk is managed through architecture, not iteration. Here is the precise distinction. A pivot is not a strategic maneuver. It is an admission that the original architectural assumptions were wrong, that the product was built around a hypothesis that did not survive contact with the market. Most pivots are dressed in the language of agility and responsiveness. The underlying mechanism is a structural miscalculation. The business was built on an unverified assumption, the assumption was invalidated, and the architecture that expressed it now needs to be partially or fully rebuilt. The pivot is the symptom. The unverified assumption is the disease. At Arco, we do not allow unverified assumptions into the build phase, not because we are more talented at forecasting, because we enter markets where the verification has already been done by the customers who have been paying incumbents for years to deliver a service that our architecture will deliver at a fraction of the cost. The experiment is not the build. The experiment is the market analysis that precedes it. By the time engineering begins, the experiment is over. Startups pivot to find revenue. Arco engineers to capture it. When you build an MVP, you are building something designed to be replaced. That is not an accusation, it is the stated purpose of the model. The MVP exists to be invalidated, iterated, and eventually rebuilt into something that actually fits the market. The problem is what happens when it succeeds before it has been rebuilt. The cost of technical debt in established organizations is documented by McKinsey Research. 40% of IT budgets consumed, not by building new capability, but by maintaining the debt that the previous shortcuts created. In an MVP stage startup, that proportion does not arrive slowly. It arrives at the moment the business finds its first real traction, when every engineering hour spent on refactoring is an engineering hour not spent on growth. Stripe's developer coefficient research puts the human cost at 42% of developer time lost to managing technical debt rather than advancing the product. These are not abstract figures. They are the operational tax on every architectural decision that was deferred in the name of moving fast. The mechanism that produces this tax is identical to the one that produces the coordination tax we examined in episode 3. Technical debt and coordination debt are structural cosants. Technical debt is the deferred cost of building infrastructure for exploration rather than permanence. Coordination debt is the deferred cost of building organizations for human execution rather than agentic architecture. Both compound silently until the business hits a scale where the deferral can no longer be absorbed. Both arrive at the worst possible moment, when the business needs every resource for growth, not for reconstruction. We call the cost of that reconstruction the rebuild tax, the engineering expense of re-architecting a system that was never designed to scale, paid at the moment when scaling is exactly what the business is trying to do. Most MVP-built startups that find success pay the rebuild tax. They reach a point of traction and discover that the architecture built for speed cannot carry the load the business was built to generate. The founders who built the business then face a choice: hold the growth to refactor or carry the technical debt indefinitely and watch it accumulate into a ceiling. Most carry it. The ceiling arrives anyway. There is a deeper architectural reason why the MVP model is incompatible with what Arco builds. An MVP is, by definition, an automated business at best, built for a human to operate while the product is being figured out. The human is at the center, managing exceptions, overseeing outputs, steering the iteration. The architecture is built around that human presence. We established the distinction between automated and autonomous in episode 1. An automated business optimizes human workflows. An autonomous business replaces them with deterministic architecture. An MVP cannot become an autonomous business through iteration. The logic that autonomy requires, clean sheet design, T-tier classification, architectural certainty, cannot be retrofitted into an architecture built for human operation. Autonomy requires reconstruction, not optimization. And reconstruction is exactly the rebuild tax. Arco targets zero refactor infrastructure from the first line of code. That is not a performance claim. It is the consequence of the market selection process, which is the subject of the next segment. When you know precisely what you are building before you build it, you can build it correctly once. The cost of building correctly upfront is higher in the first 60 days. Over a 24-month horizon, it is significantly lower, because the rebuild tax is never paid. The question we get when we describe the no MVP model is always some version of: if you don't test with real users, how do you know the architecture is right? The answer is that we separate two problems that the MVP model conflates: market risk and execution risk. Market risk is the question of whether demand exists, whether customers will pay, in what volume, at what margin, and for how long. In a speculative market, that question is genuinely open. In a proven market, it has already been answered by years of documented commercial activity. The incumbents serving that market are the proof of demand. Their customers are the proof of willingness to pay. Their revenue history is the proof of market stability. Market risk is not a variable we need to test. It is a condition we verify before we commit to building. Execution risk is the question of whether we can deliver the same outcome more efficiently than the incumbent. That is not an open question in the same sense. It is an engineering problem, and engineering problems have deterministic answers if the architecture is designed correctly. Our execution risk is bounded by the quality of our market analysis and the rigor of our architectural design. Neither requires an MVP to resolve. The research phase that replaces viability testing runs against three criteria. First, demand stability. We need a market with a track record of at least a decade of consistent, repeatable demand, not a trend, not a growing category, but a structural need that has produced reliable commercial activity across economic cycles. Second, incumbent inefficiency. The market must be served by operators whose delivery model is structurally dependent on human labor. Firms where the coordination tax is not a marginal cost, but a central feature of how the business runs. Third, labor to margin ratio. We look for markets where human labor accounts for more than 60% of gross margin, industries where the incumbent is profitable, not because their model is superior, but because no one has rebuilt it yet. This is the definition of operational arbitrage, the cost and output delta between a human-staffed operation and an equivalent agentic one, widening every quarter as compute costs fall and human costs do not. To make this concrete, consider a professional services firm handling high-volume back-office compliance work for financial institutions. Demand stability. Financial institutions have been outsourcing compliance processing for 30 years and will continue doing so because the regulatory requirement is structural, not discretionary. Incumbent inefficiency. The firms currently serving this market employ large teams of human reviewers whose primary function is to process deterministic documents according to fixed regulatory rules. Labor to margin ratio. In a typical back-office compliance operation, human labor accounts for 65 to 75% of gross margin. That market passes all three criteria. The customers are proven, the incumbent is structurally slow, and the case for agentic reconstruction is arithmetically obvious before a single interview is conducted. When a market passes that analysis, the question of whether an MVP is needed answers itself. We are not entering to discover demand. We are entering to capture demand that the incumbent is delivering inefficiently. The architecture of the business is determined by the market's operational structure, not by user feedback cycles. We know the task tiers, the agentic coverage, the human oversight threshold, and the target operational drag ratio before the build begins. The only variable remaining is execution, and execution inside a studio with shared infrastructure and a model that compounds across every build is a manageable variable. The next episode covers this selection process in full, how we identify the markets that allow us to skip the viability phase entirely, what makes a market certain enough to build into directly, and what disqualifies a market, no matter how large the opportunity appears. Why does Arco reject the MVP model? Arco rejects the MVP model because it is a tool for managing market uncertainty, and Arco eliminates market uncertainty before building. The studio enters only proven markets where demand has existed for a decade, which removes the primary variable that MVPs are designed to test. This allows all engineering effort to focus on architectural certainty. Zero refactor, autonomous systems designed to scale from the first line of code. Technical debt accumulated through iteration is a structural liability Arco treats as a design failure. The rebuild tax, the cost of re-architecting a system built under MVP conditions, is paid at the worst possible moment. Arco does not pay it. Here is the test. If your business model requires discovering whether a market exists, you are still running an experiment. Arco does not run experiments with engineering resources. We run experiments with research before the build begins, before the architecture is committed, before the first line of code is written. By the time we build, the experiment is over. The rebuild tax is the price of the alternative. Every architectural shortcut taken in the name of shipping fast is a liability that compounds until the business is large enough that the compounding becomes visible. Most companies discover the liability at exactly the wrong moment, when growth is accelerating and every engineering hour spent on reconstruction is an hour not spent on scaling. Arco pays the architectural cost once, up front. We do not pay it again. The full written version of this argument is memo number 4, Why We Don't Build MVPs, on the blog at arcoventure.studio. The Arco Lexicon at arcoventure.studio/lexicon defines every term introduced across this 4-episode arc. Next week, how we identify the markets worth building into. What makes a market certain enough to skip the experiment entirely? We don't build versions that might work. We build infrastructure that does work. This has been episode 4 of the Operator Log.